portfolios. She is currently a member of the CFP of Pittsburgh and has previously served as both president and director of that organization. She is a board member of a number of entities, including Robert Morris University, her alma mater, the Treasury Market Practices Group, and the Depository Trust and Clearing Group. But before we hand it over to her, one minor housekeeping item. We have muted everyone, but would still welcome questions from all of you. You will note on your screen the Q&A icon. Hit that, type your question, and we will address it at the end of the presentation. Debbie, thank you for coming.
Thank you so much. And it's great to be with you all here again. I am going to apologize. I am actually at a conference in New York City, and I thought it would be a great idea to do this from what is basically an outside balcony about maybe 12 stories up with the Chelsea Pier well below me. By the time I realized that it's very bright out here, it's windy, and there is a lot of helicopter traffic in and out of the pier, in and off the pier. It was too late to pivot at that point. So if you're distracted, I again apologize for it, but hopefully everything will go as planned and will work well from an update perspective, with just a little bit of a different background this time for the quarterly update. Just addressing some of the newest things over the course of the last quarter. Obviously, we continue to have a Fed that's in motion. Some of the most recent rate hikes that took place, at the end of the second quarter and into the third quarter, you ultimately had, the Fed moving unexpectedly 75 basis points in June, expectedly 75 basis points in July, expectedly 75 basis points in September. And when we move forward for the rest of the year, our thought process is we'll see another 75 basis points here in later this month, maybe down to something that's more like 50 basis points in December. And then again, depending upon inflation being the key to all of this, sort of increasing rate environment, depending on that, 50 or 25 basis points as we, round out the year of 2022 and head into 2023. So, what are the impacts from a fund standpoint over the course of, the last quarter? Well, you essentially now see money market funds. And again, depending upon, what share class, whether you're in a government product or a prime product or a muni product, you're basically seeing net yields that are in the high 2% levels to the low 3% levels. And that's basically where we are from a Fed standpoint at this time, which the current Fed funds target rate is 3 to 3.25%. And the current reverse repo rate, which is supposed to be sort of a base for short-term rates in this marketplace, stands at a 3.05. So fund weighted average maturities, including, basically all of our products at this point, are very short. Some of them are in a 15 to 25 day weighted average maturity range, some of them 20 to 30 days, some of them 25 to 35 days, all depending upon their markets. But in reality, the majority of our weighted average maturities at this point are in the high teens to low 20s. So when the Fed moves, or when the yield curve starts to move in anticipation of further movement from the Fed, that's when you see our funds yields increasing. And that has basically, been the case since we, flipped the calendar into 2022. I can tell you that on a daily basis, we discuss, when should we change this? When should we, begin to extend? When should we stop buying as much in floating rate securities and start buying more in 6-month or 12-month fixed rate securities. And although we've dabbled in that, we're not clearly seeing an end yet to this Fed cycle. And as such, with inflation ruling the roost, we've continued to basically keep very liquid, very short, and very responsive to short-term rate movements. Just today, the producer price index, is one of our indicators that we watch from an inflationary perspective, came in again higher than expected. I think it was supposed to come in at 8.2%. It came in at 8.4%. On a month over month basis, came in at 0.4% versus 0.2%. Tomorrow we get another, showing of inflation from a CPI standpoint. It's expected that will come in a little bit lower. But, those expectations didn't come to fruition today with PPI. So time will tell what happens from a CPI standpoint tomorrow. Bottom line is, though, clearly inflation has to peak and start turning down. It doesn't have to get down to the Fed's range of 2 to 2.5 or even 3%, but it has to be on a clear path downward before we see the Fed, stopping the interest rate environment that we're currently in. If I look at the terminal rate that's currently being predicted, from a Fed perspective in the 4.5 to 5% range, that is something that we agree with. We got there sooner than the Fed, probably as early as mid second quarter, after the Fed began to raise rates in March of this year. The Fed has basically just gotten there with their most recent, September summary of economic projections, where all of a sudden they're seeing GDP slow down at a more marked pace, inflation stay higher for longer, and ultimately, basically the theme that we've been saying from an investment perspective in the liquidity markets over the course of this year, rates are going to be higher sooner and for a longer period of time. That being recognized now more clearly by the Fed. I think as far as the Jackson Hole, testimony or presentation and subsequent Fed meetings, what you've seen is Chair Powell and the rest of the Fed governors and voters at this point with a very clear message. We have to control inflation. Yes, we realize it has potential economic consequences, recessionary even potential in nature. That's not a zero risk chance, but we have one clear goal in mind at this point, and that is fighting inflation. That's a bit of a refreshment from my standpoint, in that we don't have Fed governors and Fed speak going in, sort of different directions. There seems to be one clear voice at this point. I think the other thing that's changed with the most recent set of economic projections is where we're going from a 2023 standpoint. Prior to this September set of projections, you basically saw a Fed that was, in their estimation, voting on the likelihood that they begin to reverse some of these increases that they've had in 2022, maybe as early as mid-year 2023. That's clearly off the table now. That's why, the for longer in our theme at this point, we think is now even more solid in the context of, where we expect 2023 to end up from a rate perspective, and to continue with, sort of rate cuts then probably, in our estimation, delayed till, if anything, very late in 2023, and more than likely 2024. Does this send us into a recession? Or is it more like a soft landing, or, somewhere in the middle of those two, maybe a little bit of a rocky landing? It seems like the potential is there, but you still have a very strong consumer at this point that is not shying away from spending yet. They're weathering the storm of, what were high gas prices that have come down now, relatively substantially. So they're weathering that. They continue to weather, increasing interest rates. It's been basically, we're at the 6-month time period now from when the Fed started to raise rates. And that's generally the amount of time that it's expected for, some of the impact of these rising rates to be felt. And we're seeing that from a housing market perspective. I mean, virtual doubling of short-term interest rates is and mortgage rates is what we're seeing. And yet the housing market remains strong. Not as strong as it was when we flipped the calendar into 2022, but prices are remaining firm. Overbidding has seemingly gone out of the marketplace, and you're now got a bit of an inventory, a couple months worth of inventory, whether you're talking about new construction or, maybe existing homes, maybe, 9 or 10 months worth of inventory. But that's really, compared to what was unrealistic in, maintenance or continuing earlier in the year, where you basically had 10 hours worth of inventory. So, the consumer remains strong, and that does continue to be the largest part of our economy. From a strong dollar standpoint, that really hasn't impacted, the next largest sector of the economy, which would be, sort of the corporate area. Earnings, surprisingly, to some degree, through at least, the second quarter, we'll start seeing what the third quarter brings here soon, have remained solid. We've, continued to see earnings increases, maybe not as much as what we saw in 2021, but we're not seeing earnings cut back at this point. And I think because of supply chain issues in other parts of the world, in the global economy, that maybe necessarily has allowed the US side to continue to provide pretty good earnings and profitability statistics that have kept that sector fairly strong as well. Government stimulus, obviously we're ending those days. We don't intend to go into, any kind of a market where the UK, made the very large mistake of having monetary and fiscal policy, basically announcements, fighting each other. That's not something that the US is doing. But having said that, the government is not providing the floor underneath the economy as it was in 2020 and 21. Nonetheless, could we skirt a recession and go down basically to a 0 to very low growth environment where, maybe you have a quarter or two in negative territory, as we already have at this point, with, a quarter or two at 0, with a quarter or two at maybe 0.1 or 0.2, that's in our minds, quite a possibility. But the potential for a recession or a rockier type of a landing, has grown in our minds. It's not the top expectation, but it's grown. So it is something I think that we still have to be concerned about and, look for in the context of not an unlikely outcome at this point. Some of the more impacted industries that we've seen, obviously, anything with chip technology associated with it, anything with, natural resources and any type of energy associated with it, anything from a supply chain and labor shortage standpoint. I think I've mentioned here before the very low participation rate that we have in the US for labor markets. That continues to be an item I think that the Fed reckons with. And although they're trying to control that through, the rates market, I'm not sure that it is. It seems as though people have made some lifestyle changes during the pandemic that maybe negate some of those increasing rate environments that, have historically worked with bringing participants back into the labor market. So that remains, to be challenging. As far as trying to figure out from a standpoint of cash allocations for the investment community, we basically, within our own at Federated Hermes, longer term fixed income and equity products remain at our highest cash allocations in decades, essentially. So we have not made the determination. We may have gone from a duration that was something as, low as 87.5% of the market to something that's basically on par with the market at this point. But we've not reduced our cash positions at this point and find it useful in, kind of controlling where we are from a return perspective and helping stem some of the outflows in that sector. So cash allocations remain strong within our own products. Certainly from our clients' perspective, we remain, the asset sector, if you look at money market funds since the Fed started raising rates in March, the government sector is up probably about 5%. Now that's the largest sector, but it's the smallest allocation or smallest increased allocation at this point. The prime sector is up probably high teens to 20% at this point. And the municipal sector, despite some of its rate challenges here a couple of months ago, has came soaring back and is up probably to the tune of almost 30% in the current, again, time period from when the Fed started raising rates in March. So, people are looking at cash allocations still remaining high from a client standpoint, and they're looking at maybe diversifying away to some degree from a standpoint of, their risk metrics out of the government side and into, some of the higher yield, higher spread type of sectors in the prime and muni sectors. I think when we look at, newest concerns or risks in the marketplace at this point, there's really, kind of maybe threefold. Number one would be, based on when the Fed decides to stop. It's important to stay, wary of what the Fed is doing and how that impacts these products, and ultimately the resulting, phase of what that produces in yields and NAV movement in the products. They're stable net asset value products, but if you're in, an institutional prime or institutional muni product, you're going to see that fourth digit move around. And, by staying short, we can try to control that as much as possible. But then again, you don't want to be stuck too short at a point when the Fed stops. So I think that's a risk. When does the Fed stop? When does the pivot need to occur for lengthening in this marketplace? And, are there those that are left behind in that process? We certainly don't want to be one of those. I think a second concern is where we are from a credit cycle perspective. If in fact we do have, what is certainly a growth slowdown and what is potentially a recession in the near future, what does that do? What are the most impacted sectors from a credit quality standpoint? The municipal sector remains strong. They're, the coffers have been filled from a subsidy perspective by the U.S. government. They have not been spent from state and local government standpoints. Tax receipts remain and inflows remain strong there. The banking sector came into this downturn with stellar banking balance sheets, very little leverage, high earnings, high equity, and cushions and loan provision amounts based on what were negligible, loan problems at that point. We think that's something that we'll continue to have to watch and keep alert, especially as much in a global sense as it is even from a U.S. sense. You have the recent issues that are happening in the sterling market, the sterling bond market over the course of the last 2.5 weeks. And, large issuers from a sterling bank perspective that we regularly utilize, would be both Barclays Bank and Lloyd's. So they're on our radar screen at this point, and maintaining, our exposure to them and duration with them is something that we're constantly reviewing. In a similar, sort of global bank perspective, Credit Suisse has had continuing what I'll call maybe governance issues, and how that's broadly impacting, their perception in the marketplace is something that, again, from a credit quality standpoint, we have our antennas up at this point. And then to the extent the dollar becomes too strong, to the extent that there, inflation remains higher for longer, you have the impact on what that does from a broader corporate perspective in the market too. So our analysts are very busy at this point, assessing and making sure that as we maintain our credit quality, we are wary of sort of the conditions that are changing. And then, lastly, I think there are forces that we can't really control, but continue to impact us in a pretty large way. The Russia-Ukraine situation is one that is at the forefront of that. And, what that means from a global perspective, what that means from an inflationary supply chain perspective, going forward is something, that we're always trying to, sort of pinpoint and assess. Again, trading partner tensions and how that impacts earnings here in the U.S., I think is, also a part of that. And, although it's a beautiful sunny day here in New York today, we're heading into cold and flu season. COVID isn't gone. It continues to come down from a numbers and a hospitalization standpoint. But nonetheless, I think that is a risk that we have to deal with going into, the colder months when people are spending more time indoors and are more prone to those types of issues. So, overall, I think from our outlook standpoint, it's very good with regard to money market yields following Fed yields, which are going to not stop rising in our estimation over the next 6 months or so. And excuse me. And with risks that are not outsized from a credit or global perspective, that allow us to keep comfortably invested in the products. And, our antennas are up for always looking out for that situation when it changes. Our prediction is not for a recession, even a mild one, but it's a lot higher on a percentage basis than it was before. So again, we look, especially when you have the FOMC and the chair himself constantly apologizing for what the impact might be on U.S. citizens, on households, on companies, operating here in the United States. If in fact we do go into recession, makes us a little bit more concerned about that potential, but not at the top of our list right now. So maybe with that, I'll stop and see what questions this potentially could have invoked.
There we go. Sorry about that. It took me a while to figure out how to unmute. We have a few questions. What do you see as far as rate hikes for 2023? Any guesses in your magic mirror as far as percentages and number of rate hikes?
Sure. As we head into 2023, we think the Fed is at or goes to something that is more like a 25 basis point hiking process. We don't see it stopping, but maybe first quarter, January and March increases, and then maybe potentially in doing one more in the second quarter. But again, thinking that impact at that point, which will now, result in a terminal rate that's probably in the 4.5% to 5% range, but thinking that the impact on that will be reduced inflationary prints, and as such, something that the Fed then can feel comfortable with as far as, sort of stopping and assessing and maintaining. So we don't see it ending in 2022, but we do see it, decreasing and stopping, by at least mid-year 2023 if our expectations on inflation come to fruition.
So there isn't any real hope of a rate cut anytime soon?
We don't think there is. The theme, as I mentioned earlier, of higher rates sooner and for a longer period of time, i.e. through 2023, continue to be our dominant outlook at this point, with, unless something goes, drastically wrong, rate decreases not really hitting the scene until 2024.
What about the election? Is that going to have any impact?
I mean, it's certainly, we try to keep, politics out of this, and would be happier if it didn't have any impact on what's going on from a rates market perspective. But having said that, I'm not sure that that's a wise, that in fact can and does happen. So, the November elections, is it something that, maybe causes the Fed to reassess to some degree and start their, sort of decline in tightening amounts? So maybe we go from 75 basis points down to 50. It does not, however, in our estimation, impact them in a way that would cause them to just stop raising rates. I know there is, sort of a common theme historically that the Fed does not raise rates into an election time period if they want to maintain, sort of where we are from a policy perspective with the current administration. But that's not the Fed's goal at this point. And certainly I think Powell couldn't have been more clear that their goal is fighting inflation. And, that is not going to, sort of skip a beat because of the potential for, winning and losing House seats or, gubernatorial races in the context of the November elections.
A question here. In Alaska, we may have more connection to the international markets than maybe some other places in the lower 48. How do you see the international environment?
Well, I was over the course of the last quarter, I've actually been to Europe twice, which is, something that was not the case over the, course of the last 2.5 years. What is notable to me is how much the UK has become less of a dominant force in the global market. So, we headed into the pandemic where Brexit was still, sort of something they were dealing with at that point. And to a large degree, I think there has been more of an impact from Brexit than had ultimately, been thought that, would be considered. So, I think you have a major trading partner that's definitely aligned with us in most instances now, having less certainty. And like I said, the last 2.5 weeks have been rather tumultuous in the bond market there because there's a new, and there's a new prime minister, and, the thought of sort of aligning monetary and fiscal policy was something that was sort of missed. And, you had a reaction from a market perspective that's not been very pretty. So, I think there is reason to believe that they will be less impactful than historically they've been as a trading partner. Europe, on the other hand, is currently, sort of continuing to be devastated with what's going on from a energy source standpoint. Will they have a heat through the winter? Will they, that there be, are their governments going to be forced from a stimulus perspective to shore up based on, leaks and basically, no longer having access to sources that they have historically done? I think that might be the case. And, so it's going to weaken, again, their current, sort of fiscal and monetary process in order to reckon with those things that, although they're impacting us here in the US, not in a same and direct fashion. And then from an Asian standpoint, there are certain trading partners there, China being probably the largest, where, we continue to have what are hopefully not irreconcilable differences, but they continue to be challenging differences. And so, I think that means what has been a fairly strong growth from a global perspective because of some of these, challenges in other parts of the world, is going to slow. And when that happens, we've got to make sure that we, from a U.S. perspective, have that all in perspective and are able to, sort of can control our own production, our own processes in a way that are more reflective of what we're doing here. So I think, the global situation is, I wouldn't call it unstable or tenuous, but it has more of a potential impact than sometimes it has historically. Now, having said that, Canada and Mexico, which are our largest, trading partners at this point, continue to be, on a pretty even keel and aligned with us. So, that's something that on the stable side of the equation is working for us at this point.
One other question. Back in 2021, the price of diesel was $3 per gallon. Now up here, it's $5 a gallon. Do you have any insights on fuel prices going forward?
Well, it's definitely something we thought was going to have a bigger impact on consumers than it actually has so far. And quite honestly, it was, it's off its highs. It was, $6 per gallon, back down to $5 per gallon, even under in some places. But we certainly thought that the summer travel season was going to be very devastated because of some of that, and that might, some of the oil and gas prices, and that would, sort of be a drag on an economic growth standpoint. And we have seen that, but the consumer still, from a retail sales standpoint, is not stopping. Maybe they're slowing a bit, and that will will hopefully be continuing to be the case, where, discretionary income, consumer savings is able to, sort of stem some of the concerns about higher gas prices, higher oil and heating prices. But we still think it's definitely something that will be of an impact, maybe not as large of an impact in slowing the economy going into 2023.
Thank you. That appears to wrap it up for the questions. Thank you again, Debbie. Thank you to all our guests for attending. We are scheduled again on January 11th, so mark your calendars, look out for the invitation. And we wish you well in these challenging times and look forward to helping you as best we can. Thank you so much.
Thank you. Have a good day, everyone.